What's up, everybody? Excited to learn and teach about buying a home. We'll give people a couple minutes to get logged in. I love talking about this stuff, man. So this is going to be awesome. We're gonna help everybody out, teach everybody about this home buying process, and answer a bunch of questions. So excited to get started. Bump, bump, bump. We'll give people a couple minutes. What's up, Ashley? Good to see you. Cool. Awesome. Awesome. Getting logged in. Good stuff. It's good to have a big group. Hopefully my sound is okay. My video works, all of that fun stuff. So we will see how it all goes. Bump, bump, bump. Cool. I'll just get right into it, man. I know time is valuable, so I appreciate everybody jumping on here to learn about buying a home. Right? I think 2024, a lot of people have goals and want to own a home, and so it's important to learn the process, right? And I always say, you don't know what you don't know, and learning about buying a home is super important, right? And it's just one of those things you don't learn. So the goal for us today is that you can either A, start the process of getting pre-approved, or B, help you come up with a plan so that you can begin that process of getting approved, right? And so knowledge is power, and that's why we're here. We're just here to educate you and teach you some stuff. So let's see if I can click through. Hopefully my slides work. Cool. So those of you who don't know me, I'm Joe Soto. I always like to joke, husband, father, all around good guy, who also does mortgages and loans. I've been in the mortgage business since 2004, so just on 20 years, and have helped tens of thousands of families over the years. Right, my team is here in Cypress, California. We lend in all 50 states. I've been in the top 100 of loan officers at my company, out of like 2,400 loan officers. So we do it at a really good job, at a really high level. But we got three pillars that we focus on. We focus on education, we focus on empowerment, and we focus on execution, right? The three E's. And so we want to educate you. We want to empower you on making a good decision, financial decision when you're buying, refinancing, investing in real estate. And then we want to execute. We want to get you into that home, and we want to show you the benefits of home ownership. So that's who I am. I'm looking over at my slides. Tell you a little story about the home buying process. So I grew up in Brooklyn, New York, single mom. She worked two jobs. I've known since 13, just work really hard, right? And so get a call a couple of years back from a friend of mine, good friend Eddie. And his wife calls me up, and she's never called me a day in my life, by the way. I've known Eddie since I was 13 years old. She's never called me one time. And she says to me, she goes, Joey, she goes, I'm calling you because we need to move. And I'm like, okay, you're in Brooklyn. And she goes, Eddie and my dad are going to kill each other. Like literally, we can't live under the same roof. It's horrible. Like we need to get out. I'm going to go look at some apartments this afternoon, but Eddie keeps pushing me to call you. So I'm calling you because he thinks we could buy a house. But I tried to explain to him that people like us don't buy homes. And when she said those words, it hit me like a freight train. And I was like, wait a second, what do you mean? And she goes, people like us, like we don't own homes, right? And I'm like, that's not true. And she's like, no, you're different. You moved out of the neighborhood. You're like one of like 1 million, right? Like we just need to rent an apartment. And she was really fired up. Like her and Eddie had just gotten into it. And I was like, Naomi, I don't believe that to be true, man. I think you're wrong. And she's like, whatever, let's just see what we can do. And that was September 9th. I believe it was 2018 that she did that. So that was a long time ago, still resonates with me today. Fast forward from September 9th to December 17th. And I call Naomi up and I said, Naomi, it's Joey. And she's like, hey, what's up? I said, hey, what are you doing? And she's like, we're on our way to the attorney's office. And I go, oh my God, Eddie get arrested? She goes, come on, so stupid. We're going to sign papers. And I knew this. I did the loan, right? I was aware. I knew where she was going. And I said, "Oh, you're signing papers. Is that today?" She goes, "Yes, it's today, stupid." And I said, "Cool." I said, "Do you remember what you told me that first day we spoke?" And she goes, "I don't know. I said a lot. I was like, Eddie and my dad were going to kill each other. Like, I don't, what did I say?" And I said, "You told me that people like us don't buy homes." I said, "Do you remember saying that?" And she said, "Did I really?" And I said, "Yeah." I was like, "That's what you said." I said, "And where are you going right now, Naomi?" And she said, "We're going to close our home." I said, "You're going to close." I said, "Because Eddie thought it was possible, and I got with you guys and showed you what you could do. And sure enough, there you go." Right. And she goes, "Yeah." I go, "So you're wrong." She goes, "I was wrong." She goes, "You guys were right. I was wrong." And so I share that story with you because you might be on here watching this and you might be thinking the same. Prices are high. Inventory is crazy, right? Like, how do I get in? I will tell you that Eddie and Naomi got in on a tiny little duplex in New Jersey, and they bought that property. They then bought a second property, rented out the first one, bought a second one, and then they bought a third one, and now they live in their pretty much forever home, right? And it's so interesting to see how they've grown and how you can grow too, right? So if you're in that mindset of like, it's not for me, it can't happen. No, I'm here to tell you that you can. I'm here to tell you that it's possible. I'm here to tell you that you just need to get started. And so this is one of many steps to help you get started. So this is what we're going to do. We're going to educate you and help you out. Those of you who aren't following me on social, please do. You can catch me on all of those funny things, but we're going to go right into it. We're going to talk about a couple of things. Hey, where did my agenda go? Did it click? Oh, no, there it goes. Sorry about that, folks. Technical difficulties. Um, we're going to go through what the bank looks at, how to get pre-approved. We're going to talk about different loan types and finding a home. You could put in questions. I'll do my best to get to questions, but I really want to get the information out because I know, time is valuable. I will get to all questions. So if you drop me a question, I'll answer it. If I don't get to it today, I will get to it. I'll answer it. I'll call you and go over it. So just fire away the questions for sure. But when you're buying a house, right, the bank is going to look at three things. They're going to look at income, credit, and equity, which is down payment, right? And so those are the three things that the bank looks at. And let's see how the bank looks at each of those things so we can help you out, right? So how does the bank see your income? Cool. Well, there's two types of employment, right? You either work for a company or you work for yourself. Either or is fine. If you work for a business, um, drop me a line or give me something in the chat. That'd be cool. Or you work for a company, right? So if you work for a company, you get a W-2. It's pretty easy. When the bank qualifies you, we look at your W-2 and we take the income off of your W-2. However, um, when we do look at that income, we look at bonus, overtime, and commissions. So if you get bonus, overtime, or commissions, meaning you're not just salary, right? If you're just salary, it's cool. I make 120 a year, divide that by 12, bank gives me credit for 10 grand a month. But if you have overtime, bonus, and commissions, the bank is going to want to see that you've earned that for 2 years. So let's just say you're a truck driver and this year's been really good, or last year, 2023 was really good, and you had a lot of overtime. But 2022, you didn't have as much. The bank is going to average that over the 2 years. So instead of making $500 a month of overtime, which is what you're doing now, the average might only be 210. And that's what the bank is going to give you credit for. It's a 2-year average, overtime, bonus, and commission. Um, 2-year history, we're going to want to see a 2-year history of employment. But the big misconception out there is that you have to be at the same job for 2 years, or you can't switch jobs and buy a house, right? Like, that's not true. The bank's going to want to connect the dots and make sure, that your income is stable, but they're not so stringent to where, if you're an HR manager, then you got to be an HR manager at the new job, right? Or if you worked at, in sales and now your new job's got to be sales, where if you went from sales to HR, cool, you're okay, right? As long as it's stable employment. Typically, cash does not work when you're buying a house, right? Everything has to be documented. So cash tips, servers, bartenders, it's a little bit more challenging to get financed. There are programs which are called non-qualified mortgages where you can use some of this income. Typically, you got to put more down. You're going to have to put like 20% down, but you can qualify um, with that program and use some cash. But they're harder to get. And if that's your situation, just shoot me a message and I'll walk you through some of that. If you're self-employed, we're going to look at your taxes, right? And so the challenge with being self-employed is you make 100 grand of sales or income, right? And then you write off 90 and you're left with 10. And you're happy because you didn't pay Uncle Sam a lot of money. And you're saying, great, I just won. I didn't pay anything in taxes. But from a banking standpoint, we're only going to give you credit for 10 grand a month, a year, sorry, 10 grand a year of income. That's not enough to buy a house. So when we're looking at your income, you got to be very careful on your deductions and what you take, because if you take too many deductions, it's not going to be good, right? So be very, very careful. If you are self-employed, we typically want to see a 2-year history of self-employment. Another huge mistake people make is that they go from a W-2 position to self-employed. If you are a W-2 employee at, I don't know, let's say the county, you have a city job. Let's say you're a postal worker. Jeez, I couldn't think of anything. You're a postal worker. And then you decide, you know what, I want to open up my own trucking company. And then you leave the post office and you go start a trucking company. You will have to have that company for 2 years before the bank will let you use any of that income. So buy a house while you're still working for the post office is the moral of that story. If you have any questions on that, just let me know. Now, another question that we get all the time is if you've been in school, trade school, nursing, doctors, you're getting some sort of degree, vet tech, I mean, whatever, x-ray tech, some of that stuff. Education can count as employment, right? We're going to let you use that as employment. So you don't have to be, you can go from an LVN to an RN. And now as an RN, they're going to pay you way more per hour. You can use that hourly rate right away, right? You don't have to wait for that. Same thing if you're a union employee or something like that. Like what the new pay raise is going to count. What doesn't count is if you have overtime, if you have bonus or commission, right? Like that, you still need to have a 2-year history of. But let's say you're in school to become a physical therapist, and then you graduate. Now you get a job at a clinic or a hospital or a place, and now you're making quote unquote real money, right? That income can be used as soon as you start if you have an employment letter. So you can definitely, there's ways to work around it. If that's your situation, just reach out. We can help you out and navigate through all of that. Cool. My mouse is very sensitive today. Finding your down payment. So one of the biggest challenges is the down payment. And most people think you need 20% down or 3.5, or you can only get a conventional loan for this amount down or whatever it may be. That's not all true, right? And the down payment can come from lots of different places. So in regards to your down payment, traditional sources, right, are your savings, your checking, 401ks, gift funds. If you're getting a gift, if you happen to be fortunate to have a gift, somebody who can give you a gift, it always has to be properly documented. So if you're getting a government loan, which is FHA or VA, whoever's giving you the gift has to provide their bank statement. So you got to be careful. You can't have cash deposits or anything like that. If you're getting a gift on a conventional loan, then the gifter can just give the money to the escrow company and we don't track it as far as where it came from. People are cashing in stocks. They are using annuities. If you worked at a previous company a long time ago and maybe you had a 401k and you're like, I don't know what I did with it. I can't tell you how many people will go back and say, oh my gosh, I have 15, 20, $50,000 from this company I worked at 5 or 6 years ago. I didn't even realize, I didn't even roll it over. So that's stuff that you can do, right? As far as using that income. And then there's down payment assistance programs. We'll call them DPA for today. And we'll touch on some of those that are local here in California. Every state has different programs, right? So every state is going to have different things that they offer. Arizona just had one called a Lighthouse that they did. And, if you're in a certain city or area and you're interested in that, you could always Google the city and down payment assistance programs. Stuff may come up to find some things. And, if you find something and you want us to research it, just reach out. I can lend in all 50 states. And if there's a specific program, odds are we can do it. I mean, we do almost everything. So um, that's it on down payment. Let's see how nope. Come on, Joe. Click. All right. So when you talk about down payment, I think one of the big misconceptions people have is I just need 3.5% down, or I need 5% down, or I need 20% down, right? But that's not reality, right? Like I always like to talk about reality. And reality is if you're buying a house today, and let's just say you're buying a house for, I don't know, well, let's say 600,000, right? If you're buying a house for 600,000 and you said, I'm going to put 3.5% down, you're saying, cool, I need $21,000 to buy that house, right? That is the down payment. That is not reality, people. Reality is that when you buy a house, you have to pay closing costs and prepaids. And so there's two different columns when it comes to cash to close as far as how much money you're going to need. One of them is the closing costs. That's lender fees, title, appraisal, escrow, recording. Like there's a laundry list of stuff that you got to pay. Okay. And then there's also prepaids. So when you close on a house, you have to start paying property taxes and homeowners insurance. You have to set up something called an impound account. In some states, they call it an escrow account. It's the same thing. It's basically where you're prepaying property taxes and homeowners insurance for your new home. So when you buy a home, you're always ahead on taxes and insurance. Like you pay the first year of insurance today, and yet you're still going to make contributions monthly with your payment to pay it for next year. So you're always ahead. The rule of thumb is somewhere between 2 and 2.5% of the purchase price is going to go towards closing costs, right? That is the rule of thumb. So I would make sure you budget on that $500,000 house or $600,000 house. Instead of $21,000, you really may need another 12 to 15 on top of that to cover closing costs. You really need about 36,000, right? That's reality, is cash to close. So I always like to mention that on closing costs. The other part about this is if you're in a market where you can get a seller credit for closing costs, seller can pay all your closing costs. So this 15 grand, you can negotiate in the price of the house and the seller can pay the closing costs, right? Now it depends on if there's other offers, how competitive it is and all of that. That's where your realtor comes in to help you. But the seller can pay your closing costs. They can't pay your down payment. So you could get a credit for this, but not for the down. The down you got to come up with yourself. Cool. Awesome. So here's what a mortgage payment looks like. And so I like to keep things really simple. Nobody's buying a house for $100,000 in most of the markets, right? But I like to break down $100,000 increments because it's easy for me to process. And I feel like it makes it a little bit less overwhelming. And so for every $100,000 that you take out in a loan, your payment's about $800 a month, assuming you have PMI. If you don't have PMI, it comes down to being about 700, about 725, because you're going to get rid of the mortgage insurance. But here's what goes into a mortgage payment, right? It's principal and interest. It's property taxes. It's homeowners insurance. It's mortgage insurance or PMI. So anytime you don't put 20% down on a house, you're going to have to pay PMI, right? Private mortgage insurance. So this is everything that goes into a monthly payment. Some of the problems I see with online calculators is they tell you, you can own this house for this number, and they don't factor these, or they don't factor in mortgage insurance, or they don't give you enough for property taxes or homeowners insurance. So it's why it's really important to know your numbers and talk to somebody up front. So that way, you know exactly everything that's going into your monthly payment. You don't want surprises. You don't want to find a house and think, oh, this payment's $3,000 and find out it's 3,600 because that's not in the budget, right? So this is important. So if you were financing, give you some Joe Soto simple math here, folks. If you were putting 3.5% down on a house, again, we'll use 600,000. You're going to take the $800 a month, 800 for every 100K, and it's a $600,000 house. So I'm writing six. That payment's about $4,800. Simple math. Doesn't include homeowners associations. That's a different bucket, but it's really easy, right, for you to have that and say, hey, so if I'm looking at a $400,000 loan amount or house, right? Oops. I would go 4 times 800. That's 3,200 a month, right? You could pretty much do it for any number. $800,000 house times 800. Oh, I did divided, Joe. 8 times 800. You get the deal, right? 6,400 bucks. So that should help you with monthly payments. Cool. There's different types of loans that have all different types of guidelines. And so I'll touch on all of them just to kind of teach you a little bit. But there's FHA, conventional, VA, and jumbo loans. And we're going to touch on FHA and conventional for the most part. If anybody on here is a veteran and you haven't used your VA benefit, I'm telling you, it is the biggest no-brainer in the history of the world. You buy a house with zero down. You don't have PMI. You can buy rental properties. You can buy a 2, 3, or 4 unit property, live in one unit, then rent them out after. I mean, they are phenomenal. So if you've earned that benefit, you should really be taking advantage of it. If you have any friends or family who haven't used it, like, you need to talk to them. It's crazy. Like, the amount of people who don't use it, it's wild. And then there's jumbo loans. We're not going to really talk about jumbo loans. Jumbo loans is really anything above 822 could be considered a jumbo in some markets. In bigger markets, it's anything over $1,179,000. So just think high end. Think $1.5 million, right? Anything above $1.5 million is jumbo. Anything below could be conventional. And it depends on the markets because different markets have different jumbo numbers. But looking at conventional loans. So you have conventional, you have FHA, right? Those are the two main types of loans. Conventional loans, you can put as little as 3.5% or 5% down. You're going to have PMI. The higher your credit, the better your rate. So conventional loans are based on risk. Lower credit, higher risk. Lower down payment, higher risk, right? When you see ads for interest rates online, it always says this is today's rate. And if you look at the zero fine print, it will tell you this is assuming a 780 credit score, 25% down, single family residence, $200,000 loan, right? Like the perfect scenario. If you're putting 5% down on a conventional, your rate's going to be higher than if you put 25% down, right? That's how conventional loans work. You could use gift funds on these. Guidelines are a little bit more restrictive with conventional than they are with FHA, right? On FHA is regulated by the Federal Housing Administration. So they guarantee the loan. So you put 3.5% down. It's not risk-based, right? One of the things I hear from people all the time is, I'm waiting for my credit to go up. Well, with an FHA loan, if you have a 720 credit score, your interest rate is the same as somebody who has a 660 credit score. If you have a 680 credit score, the interest rate is the same as somebody who has a 780 credit score. So on an FHA loan, it doesn't matter if you work on getting a couple of points up because it's not risk-based, right? FHA will actually go down to a 580 credit score. Sometimes if you have really good credit, the PMI on an FHA loan is going to be higher than a conventional loan. But if your credit is like 680, under 700, it's actually better to do the FHA, right? FHA does have an upfront mortgage insurance premium. And if you're looking at condos or townhomes, I will tell you that FHA loans are more restrictive with regards to the guidelines. So if you're looking at condos or townhomes, you typically, even if your credit score is lower, want to go with a conventional loan. And those are the two main types of loans. Cool. We'll touch a little bit on about DPA programs. And as I mentioned, different programs all over the place. I'll touch a little bit on a local one here just to give us some information. So pros and cons, right? Good and bad. You don't get nothing for nothing. That's what we used to say in Brooklyn, right? So you're with the down payment assistance program, there's going to be less cash upfront investment. There's programs like a California Dream program where you can get up to 20% of the down payment towards your as a loan towards buying a house. So you read that right. If you're buying a place at 600,000, you could get a second loan for $120,000. Down payment assistance can be applied for down payment and closing costs. It's always better to buy than rent. Get you in the game faster. And then you can do conventional and FHA, right? And I've had clients utilize these programs just to get into the house, right? They could afford the payment, but they needed a little bit of help with down payment. The cons are typically interest rates are higher, guidelines are more restrictive, right? If the state of California is going to give you money to buy a house, then you're going to do it on their terms, right? Or if any state, if you're in Arizona, Nevada, Texas, they're going to do it on their terms. So the guidelines are going to be restrictive as far as income, as far as property. Typically, when you're qualifying, if you qualify for 500,000, let's just say your $500,000 normal FHA approval might be about 450 with a down payment assistance program. Typically, these programs have longer turn times. So you're not going to close in 10, 15 days like we do with a conventional or regular FHA. They take 30 to 45 days. And so the con to that is, let's say there's 5 offers on a house, right? And let's say they're 2 conventional, 2 FHA, and 1 DPA, right? When the seller is looking at those offers, they're putting that DPA offer last. They are making sure that that's the one that's going to get the last look in regards to down payment assistance, or as far as like getting looked at as a strongest offer. So that's the downside to it, but it does allow you to get in the game faster. So coming through here, and if you got questions, just shoot them. I'm on a roll. The number one program that we're seeing here in California, and I'll just touch on this real quick. So those of you who are out of state, I apologize, but you're going to get the California goodness anyway. Cal HFA is the California Housing Finance Authority. You got to be a first-time home buyer on a lot of down payment assistance programs. You have to be a first-time home buyer. That means you cannot have owned a home in the last 3 years. Can't be reported on your taxes for the last 3 years. It usually has to be your primary residence. That's across the board. There are limits as far as how much you can finance. I think they've just raised this, so this might be a little bit higher. Minimum FICO score. You have to have a low debt to income ratio. That's why you typically qualify for less. On this particular program, there's a couple of different options within it, right? There's My Home, there's Zip, there's this teacher program. You can't use a non-occupying co-borrower. So everybody who's on the loan has to live there. They used to allow like your parents or grandparents or anybody to co-sign. They don't anymore. But a lot of these guidelines that you see here, even if you're in another state, are pretty much going to apply, right? Here's the income limits. You can see orange, LA, Riverside, San Diego. Income limits are high. Loan amounts are high, right? Like it's easier to qualify. These numbers used to be super low. It used to be like you can't make more than 50,000. They've raised them up quite a bit. Here's how that program works. So with a lot of these down payment assistance programs, they're not straight grants, right? Like you have to pay them back. So with the Cal HFA, you get a regular, conventional, or FHA first mortgage, right? You could get a second mortgage to help you with the down payment. So let's say an FHA loan is 3.5% down. You would get a second mortgage for 3.5%. And then you have an option to get a third mortgage, which is a ZIP program. And that could be up to 3% of the first mortgage. So you can literally buy the house and have 3 loans, and then you don't have to pay them back until the home is either sold or refinanced. So if you refinance the mortgage, you're going to have to pay it back at that point. Or if you sell the house, you have to pay it back. But you don't have to make any payments on it at all unless you sell the house. Sorry for my pop-ups today. Cool. Let me know if you have any questions on that. I can definitely dig in. Again, the goal today is give you as much information as possible. And then if you want to set up a follow-up appointment, we can do that. No problem. Cool. So my company's Cross Country Mortgage. We've got lots of different programs, right? I think one of the things people think is like there's one program. There's a lot. I mean, we literally have 5 different down payment assistance programs. And so what we do when we do pre-approve you is we go through all the programs and see what you qualify for, right? So these are just some of them. We have a lot of programs. We really want to help people get into homes. There are additional programs. LIPA, MIPA, like I said, Long Beach has a program. Santa Ana has a program. Most of them are secondary loans. Every once in a while, you'll find one that's a grant. But again, you might look online and find something in Yuma, Arizona to help homebuyers, right? Or Reno, Nevada to help homebuyers. So, again, you can search in your individual area and see what's out there, right? A lot of the programs are income limited, so they're not as aggressive as Cal HFA, but you don't know what you don't know. And so, maybe you search and find something. And if you have questions, shoot it over and I can take a look. Cool. We are doing a lot of temporary buy downs. So with interest rates being higher, one of the things that we've been doing is a 2-1 or a 1-1 buy down. And basically what this does is this allows people to get a lower interest rate for the first 1 or 2 years of the loan. So I think a lot of people are projecting that rates are going to come down here in 2024, right? And if they do, the market's going to get more competitive. So how can you get in the game faster, right? That's part of this pre-approval. And so utilizing one of these buy downs, or let's say it's a 1 year or 2 year buy down, basically if the rate today was 6.5%, for the first year, you could have a 5%, and then it would go to 5.5%, and then it would go to 6.5%. So that would be a 1 year buy down, right? And basically that gives you a little bit of a cushion to work up to the higher payment, maybe rates drop. So some of these buy down programs clients have been using, this 2-1 buy down is basically if the rate is 6.5% today, the first year you'd have a 4.5%. The second year you'd have a 5.5%. The third year, and then for the rest of the life of the loan, you'd have a 6.5%. So it doesn't ever go higher than 6.5%, which is what today's rate is anyway, right? But that allows you to kind of work your way and get used to making the payment. So that's called a temporary buy down. You need a seller credit to do so. So again, you got to be able to negotiate it, but it's a program that's out there. And if you want more info, we can definitely let you know about it. Cool. So then what is a pre-approval, right? I always say when you come to me and somebody refers you to us, right, you're going to leave with 1 or 2 things. As I said earlier, you're either going to leave with a pre-approval so you can buy a house. You can go and start shopping for a home, or you're going to leave with a plan. Do you have to work on your credit? Do you have to save more money? How much money do you have to save, right? So many people are like, I'm going to save. They don't know how much they have to save. Some people think they need to save 50 grand when they only need 30 grand. So how much you have to save, right? And you could have that plan so you can move forward. But this is a pre-approval. It's an application. It's a credit report. The lender reviews your documents. You review loan programs like in person or on a Zoom and go over what you qualify for. They run an automated underwriting approval, and then they confirm purchase price and loan amount and cash to close and all of that stuff with you, right? So many people walk into a bank or push button and get mortgage and think, I'm pre-approved. If your lender hasn't done all these things, you're not pre-approved. There's a chance that you can find a house and not qualify. I just had it happen to a client a week and a half ago with Wells Fargo, and Wells Fargo gave them a pre-approval letter. And when we got their documents, they didn't qualify. And they were like, we didn't send any of this to Wells Fargo. Why are you asking us for all this stuff? And sure enough, they were in contract, found out they couldn't buy the house. So you need to make sure your lender's doing all of these things for you, okay? And here's why it's important. It validates your ability to buy. If you're trying to buy my house and you don't have a pre-approval letter, I don't think you're serious, right? It shows that you're motivated. It also allows you to close quick. when there's 4, 5, 6 offers on a house, if you're looking to buy my house and there's 5 offers, here's what I want. I want to know that you're for sure going to close, and I want to know I'm going to get my money fast. That's it. I'm greedy. I'm a seller. That's what I want. And you have to understand the seller's mindset. So the more work you do upfront, the faster you can close. And so when you're talking to a lender, one of the biggest questions that people don't ask is, how short can we do contingencies? How quick can you close? Because if there's 5 offers on a house and all of those are 30-day closes, but yours is a 15-day close with short contingencies and maybe even a per diem, you're going to win, right? You're going to beat out those other 5. And so it's really important that you lower those contingencies as short as possible. And that's all I got. If you're interested in getting pre-approved, you can literally go on my website. You can scan this QR code and you can go on my website. It says apply now from my link tree. You can apply. We can get the ball rolling. If you do that, just let me know that you're on the webinar. I will credit you for your appraisal when you do buy a home. So that's like a $700 savings for just spending a little bit of time with us. If you have other questions, put some more in the chat, send them on over. We will get to them. I promise you that we will answer all the questions. I just want to be cognizant of everybody's time here, but I'm grateful for the opportunity to educate you, to help you out. And we want to help you, right? I want to be your loan guy. I want to be the guy that you go to. So if there's any questions that you have, reach out. We're here to help you out and guide you through this process and help you be the next Eddie and Naomi. So God bless everybody out there. Thank you so much for spending some time with me, and make it a great day.